the slide that got cut off right before, this was the slide we would have gone to. So to figure out the cost available for sale for this one, it was everything what on the slide before, this is what we were looking at right before, was the purchase discount. They had a beginning balance. We didn't have that when we were doing it on the board. So if you include the beginning inventory, you add the purchases, the freight, subtract the discount and the return, and you end up with net purchases for cost of goods available for sale. Then you also include what's in inventories, same thing. So that is what you can sell, which is how we just did those two problems. Okay. Now in your homework, make sure you're including beginning inventory. Make sure you're reading the instructions, because that also is something that sometimes gets missed. You forget to include beginning inventory. Okay, so that takes us to our next step, which is sales. When you buy something, you then want to turn around and sell it. Right? So in order to do that, we have to do the journal entries to turn around and sell it. Now the journal entries for selling are a little bit different. Right? We talk about FOB, shipping point, and destination. Remember I told you it would come back up again. All right? So we got that. Now the difference here is when we pay for shipping as a seller, it's an expense. Okay? When you pay for it as a buyer, it's included in the cost of your item, because if you're going to turn around and sell it, you actually paid for the shipping. But as a shipper, you've already have your cost. You've already have your sale price. You already have your gain or loss. If you're going to pay to ship it, that's an expense. That's a shipping expense. It doesn't go into your inventory. So whether or not you pay it is based on the type of shipping you do. FOB shipping point, then you're not. FOB destination, yes, you're paying to ship it. All right, when we do journal entries for recording sales, there are always two. This is commonly missed. You guys don't like to do two. This is a 4-point question on a test, because if you only do one, you did not do the full journal entry. Oh, go backwards. All right. So every time we do a journal entry for sales, you have to record the sale, and you have to record the fact that it is no longer in inventory. So notice, they have sale for cash, so we got money. That could also be accounts receivable. And then you credit sales. Then you do cost of goods sold, right, to reduce your sales. So how much money did I make? $50. And you take it out of inventory. All right. So the very first slide I'm going to show you says that Walmart sold 2 Schwinn bikes. So they sold 2 bikes at $400 a piece, and the bikes cost $175 a piece. So based on what I just said, we sold 2 bikes at $200 a piece. We got how much in cash? $400. And our sales were $400. Now we're not done, because if that's the only thing we did, a debit to cash and a credit to sales, it would look like we made how much money? No. It looks like we made $400. Did we make $400? No. We made $50. So then we have to come in and do our cost of goods sold, and we have to take it out of inventory for $350. Remember, net sales minus cost of goods sold gives us gross profit. Our gross profit on these bikes is $50. If you do not do both journal entries, you do not get it right. You are misstating your financial statements. So you have to do both. Debit to cash, credit to sales, debit to cost of goods sold, credit to inventory. Now, just like in purchasing, we also have sales returns and discounts. People return what we have. The difference is we actually call it sales returns and allowances. Why do we want to track who returns things to us?
Because it's perpetual, we have to look for the inventories.
Right. Well, and why do we care if someone keeps returning to us? If we sell to somebody and they're constantly returning to us, we don't want to keep selling to them. Right? And even some stores, like I can't even think of the most recent one. I don't know if it's Macy's or one of those stores. You can only have something like 3 returns in a month without a receipt. Now with the receipt, most of them take the returns all the time. But if you notice, a lot of stores now, a lot of stores, not lottery stores, a lot of stores now scan your driver's license. All right, Home Depot, if you don't have a receipt, they scan your driver's license. That puts you into your system, their system, so they know how many times you return things. Target does the same thing. They keep track of people that return things over and over again, because I've actually heard someone say the other day that they won a Yeti cooler at something, and it was a big one. All right, they were saying that they were an older couple. When I say older, like mid-60s, late 60s, but they were saying they couldn't even lift it. What did they need this cooler for? And someone said to them, "You should return that to Walmart." And first of all, and it wasn't a Yeti; it was an Arctic, whatever the one Walmart sells, Arctic something. And they said you should return that to Walmart. It's like a $200 cooler. All right, so people return things that they didn't necessarily buy. So that's why they scan the ID, so you don't do that. And then someone said you should put it on Craigslist and sell it. And I don't know what the person did. The lady was like, well, I don't want to do that and then have the people see that I want it. And then I turned around and sold it. And I'm like, I'll take it. But I don't know them. So I was just listening to the conversation at a table eating lunch. So we got to track it. So we'll put in here, they will track it. So what do you think the journal entry is going to be if we have something just returned? They returned one bike. What do we have to do to this journal entry if we return one bike? We have to decrease what? Sales. So we decrease sales by debiting sales, returns, and allowances. Not just sales, we're actually going to call it returns and allowances because we want to track what the returns are. So we returned one of them. What are we going to credit? Cash. All right. So we done? We have to do the other one. We have to put that bike back in inventory, and we have to take it out of cost of goods sold. Because if we don't, then our cost of goods sold is too high, and we don't have the sales to go with it. And if we don't put it back in inventory, we have a bike sitting there that we didn't include that we could sell. So we have to go ahead and we have to put it back into inventory, put it back into cost of goods sold. All right, now just like we could get a discount if we bought something, people that pay us, we want to offer a discount too. Now here we paid cash, but we have another purchase. This time we purchased stuff from Sam's. All right, so Sam's, we purchased $1,000 worth of paper from Sam's, $230 net $60. What's the journal entry to record it? It's going to be the exact same journal entry. You do not record the discount. So if we bought, except for it's not cash, it's accounts receivable and sales and $1,000. When do I record the discount? When they pay it. How much money did I make on this sale so far? $300. All right. So right now I show a gross profit of $300. Right now I show a gross profit of $300. If they take advantage of the discount, what do you think the journal entry is going to look like? So let's assume they're paying us and they took advantage of the discount. Number one thing that's going to happen is what are we going to get?
Receivable credit.
Okay. Accounts receivable is going to credit. What are we going to credit accounts receivable for?
The discount amount.
How much do they owe us?
$1,000.
$1,000. What are we getting? Cash. How much cash did they get?
Discounted.
Did we get 1,000? No, they paid within the discount period. What was the discount? 800. So what do we put, you think, to that $200 to?
Inventory.
No. Remember, it's sales. It's going out the door. It's not part of inventory.
Oh. Yeah.
Don't overthink it. What do we call the return?
Sales.
Well, not just sales.
Sales return.
No, we called the return sales return. What do you think we call the discount?
Sales discount.
Sales discount.
Oh.
On the sales side, it's actually makes sense. And not to confuse you, but if we had a periodic inventory system, it would be called purchase discount and purchase returns and allowances. But because it's perpetual, it goes right into inventory and it comes right out of inventory. So what's the problem between ours and theirs? There's no numbers on theirs, but they did the calculation for you. Who told me it was 800? What's 2% of 1,000?
That's when you don't.
That's a big discount. That's a 20% discount.
Yeah.
And I would be willing to tell you everyone's going to take that.
I am 14.
If you pay in 10 days and you can save $200, there's going to be a lot of people paying that amount of money. All right, besides that minor error, it's correct. So, now, this was a question I got on some homework. Net sales. What is net sales? Net sales is sales minus returns and allowances
Minus discount.
minus discount. Net sales. And if you're ever asked for net purchases, which we really aren't, but it would be the same thing, but since we're doing perpetual, you don't have purchase returns and allowances and purchase discounts. All right, so sales minus returns and allowances minus discount gives you net sales. Because when you return all those things, they decrease your sales. Which returns make sense, right? If they return it, you didn't have a sale. If you give a discount, it reduces your sales. But what are you hoping to get if you give a discount? What do you get right now in 10 days? Cash. And every company, because most companies give these, I just told you a lot of companies aren't paying it. It is worth giving a $20 discount and reducing your sales to get your cash today. Get your cash today. Okay. So, now, month-end adjustments have changed a little bit. This is new. Not new to like companies, but new to us talking about in class. And they're called expected returns. All right? So basically, a cash refund has not yet been paid, but you're expecting to pay it. All right? So you're expecting to pay a refund to somebody. So to report this, you're going to decrease cash on both sides and you're going to increase a liability. Same as if the inventory has not been returned, but you're expecting it to be returned. All right? They're going to designate this inventory as estimated returns. What this is doing is it's basically saying if you know that you have to issue some refunds, you just haven't done it yet, you have to put that in as an adjustment at the end of the period. All right? And you have to put that in as a refund liability. So if you know you have refunds coming up, you have to put that in as a refund liability. If you know that you have some equipment or returns of equipment coming up, you have to put that in as an estimated return. You can't just not put it on anything at the end of the month because you haven't done it yet. If you know you're going to do it, it's a liability. And before there really wasn't a place for that. So now there is. All right, so when we're done with sales, there's our net sales. Then you subtract cost of goods sold, as we have up there, and you have gross profit. So we've explained both those formulas in pretty good in-depth way. So let's take a look. I can get my slide.